Welcome to Wyckoff Power Charting. My name is Bruce Frazier. I'm your host, and we have a very special guest today. I'm very excited to have with us Gary Fullett, and he is going to talk about his new offering, which is a video series, Wyckoff Simplified. And we are going to have an introduction and discussion about that. He is one of the premier Wyckoff educators in the world today. So I'm very excited about that. I expect that this is going to be the first of many visits that Gary is going to make to power charting. Gary started his career in 1981 as a runner on the floor, and then went on to be a trader on the trading floor. And this is where he learned and honed his craft of Wyckoff analysis. And so he has a very unique perspective about Wyckoff and a very practical learned methodology that he learned and honed on the floor. So Gary, how did I do? Did I explain that pretty well?
Quite well, very, very well. And I'm very excited to be part of what you do, because this is probably one of the most premier sites that people can go to learn Wyckoff.
Well, we're thrilled to have you. So we are going to start. First of all, I want to give you Gary's contact information. And so here is his website, LTG Trading, and here is Gary's email. And you are going to be very interested in his educational offerings that he has at his website. And so we'll move on and you'll be able to see more about that. I do have a couple of quick announcements. First of all, the TSAA-SF is going to have their annual conference on September 14th from 8 a.m. to 5 p.m. This is a live conference in San Francisco. Lunch is included. This is an incredible list of speakers. The TSAA has offered power charting viewers a special rate for the conference. So the special guest rate for power charting followers is $125 for the whole day. This is quite a value, quite a bargain. And so have a look at this, and you can go to tsaasf.org to find out more. Then the other thing is, this is something that Gary and I are both going to be involved in, and that is Best of Wyckoff 2019. And this is an online conference all day, September 2nd. And this is one of the really great Wyckoff events of the year. And so there's going to be a number of really talented Wyckoff speakers that are going to present. Here they are. You can go to wyckoffanalytics.com to learn more, but you can see here is my talk, which is going to be first thing in the morning. I'm going to speak on point and figure count objectives, and how to improve accuracy and timeliness for trading purposes. And then Gary's going to speak in the afternoon. I'm trying to find my thing here. And so Gary's going to speak in the afternoon, tape reading techniques for the Wyckoff method. And I cannot wait to hear that. A number of other great speakers are going to be there. One that I'm really intrigued with is Stella Asobo, is going to speak on Richard D. Wyckoff. She's a historian and has studied Richard D. Wyckoff's life and times, and she's going to give a talk called The Man Behind the Method, and I'm really looking forward to hearing that. So it's just a great day of wonderful speakers. Okay, so with this, we are going to now turn the screen over to Gary and let him get started. So we'll be right back. Okay, we're back, and Gary, take it away.
Yes, hi everybody. It's really an honor to be here. I want to share some things that I think you'll find of interest. I've worked with Bruce for a little while, and we happen to have very good camaraderie of Wyckoff knowledge. The main purpose is to get information and education to you, and to try to get you the best information available to you. Showing on my screen now is this my website. It's ldg-trading.com, and we do a lot of various free webinars and stock night and commodity stuff as far as that goes. And as I scroll down here a little bit, more importantly, look at the things that I'm offering. My figure is changing in figure charting. That's currently not available yet. We'll be doing that series-wise, but there's a live trade webinars, do a daily newsletter, I do one-on-one mentoring, which is unlimited and recorded for you. So if it takes 10 years, we go through 10 years. I have a starter series that did several years back. Those for people that are starting out on the various principles of Wyckoff. And I just completed something called Wyckoff Simplified. As Bruce had mentioned, I'm a former floor trader of the exchange, the CME, in the S&P 500 pit. I was on the floor for the crash of '87. Hopefully down the road, we'll share those experiences from the floor, what happened that particular day. In my Wyckoff Simplified series, I talk about how I found Wyckoff and from a trading floor perspective. And I think it's kind of unique because there's no more trading floor. So I put together a 10 videos ranging from 30 minutes, 40 minutes in duration. So if you go to my site, you'll see that. These were the topics that I decided to do because I understand that people like to get capsulized things of Wyckoff knowledge. Wyckoff principles and trade ranges, distribution tails, selling tails, buying tails, last point of support, last point of supply, reverse trend lines, where to enter trades, where not to enter trades. Sometimes you'll buy a stock and you can be liquidating but not getting the opposite position. Change of behavior versus change of trend. Extremely important part of Wyckoff. Supply line, sign of strength, sign of weakness are a very important topic. Risk management, obviously, everybody has that. Effort versus result, which is one of Wyckoff's principles. And to me, effort versus result is something that happens on a daily basis. That doesn't mean that you always can trade it, but on a daily basis that happens. Cause and effect, you could have cause per day, you could have cause for months or years. Springboards and reverse springboards are where to enter trades for a risk reward that is something that's appropriate. As I said, Wyckoff, eyes of the floor trader. I think that is unique, as I said, because no more floor trading. So,
well, and Gary, yes, these topics are so important because this is all of these themes are the portal through which we have to go to become masterful Wyckoffians. So we have to get through these concepts to get to the more advanced concepts. This is important for new Wyckoffians, and it's important for review purposes.
Yeah, I think what I really wanted to do with this Wyckoff Simplified, it came up because of my students. And they wanted to say, Gary, I understand Wyckoff from the standpoint of reading it, like we all did in class and reading it. But this is, to me, this is like taking the test. So in other words, so Gary, well, what do I buy? What do I sell? Well, we can have 10 Wyckoffs in a room. We all may enter at a different price, but we should all be equal in saying that is some type of spring, that is some type of upthrust, that is some type of Wyckoff edge to trade the market. You trade it differently, we should all be in the agreement of what that particular structure says to us. So what I tried to do is I tried to encapsulate each particular topic. You say, okay, well, you don't want to necessarily read the Wyckoff course now, which you all should. And I wanted to take this and say, okay, you want to know what a spring position is? Where to take a trade with a risk? I show that. What effort versus result is. Why market? I'll show some examples of the topics-wise of why that's important. Because instead of guessing where you're at, I'll show you exactly where you're at in the Wyckoff phase structure. And nobody does really a better job than Bruce and Roman in this subject. They take you through the actual course. I don't really necessarily, I'm more into reading the tape of what Wyckoff would say if there's 1 million shares of a stock that goes up $1, and the next day there's 10 million shares and the stock does not go up. to me, that was reading tape. I think the heart of Wyckoff, the campaign and the Wyckoff structure, what happened. So essentially, I wanted to go to the heart of trading and take the concept and the principle of Wyckoff and actually show it through live trading examples. And in
This
my
is
newsletter,
wonderful. Yeah, because these are the, what you're listing here are the actionable places. These are the places where we as Wyckofian traders want to get busy. And then you even have number 5, where not to enter trades, is to make sure that we're not getting busy in the wrong places. So this seems like a very appropriate list of uh, Wyckoff lessons.
yeah, I think, there's 3 types of trades to me. 1, where to buy. 2, where to sell. 3, where to stay out. Staying out is a trade decision.
Yes.
And what people understand is time is money. If you're entering in the wrong spot, then you may sit in a position and not knowing if you're right or wrong. So cause and effect, more gas in the car, the farther the car can go. The more of a trading range cost built, then you get to the point to where you can get the risk reward. If you're taking the market on this phase A, the left-hand side of a trading range, like the S&Ps are in right now, it's fraught with volatility and range-wise, and your level of knowledge is not great. Yes, it's volatile, and people say, "Oh, I'm going to jump into that." But this is where, the Wyckoff trader takes a step back and lets the dust settle. We're not gambling from the standpoint of trading volatility. People can go to Vegas and trade and gamble with wild bets. We want less volatility for us, not more volatility. We want the quantitative aspect of what we do. And this is what I tried to bring this as, not to tie up your money. Now, if you're a Bill Gates or Warren Buffett, tie up your money. But they don't tie their money up in a sense of, if they don't think that something is going to go for them, they liquidate that, they go into something else. Their money is working for them. So your money should be working for you. You're buying it on the left-hand side of a particular trade range, then the market to make a move, they take you months and you're tying up your equity. And let's face it, equity in this business is your bloodline, is your lifeline. So I think that's really key aspect of what happens.
Well, this seems like a very thoughtful series of lessons for Wyckofians to consider. And so you're going to show us some examples here.
Yeah, I want to show some examples, and let me show a couple quick examples of as many topics as we possibly can at this point.
Well,
This
and the
is the
thing is,
S&P
Gary,
500 index.
is we're going to have you back. So we hope that we can spend a lot of time with you in the future. So show us maybe some examples from the lessons that you're teaching, and also everybody go to his website, because there's so much free content. My gosh, I go through that, and there's just all kinds of really wonderful free content. So check it out.
Yeah, and I offer everybody a free 1-hour webinar to talk Wyckoff, because just to get an idea of where you're at wise. But let's just do real briefly the S&P. And let's talk about the effort versus result principle, which I think is one of the most important aspects of Wyckoff. So we're always judging volume versus price in the area that the market is trading in. So I know this is going to be a little bit over some people's head, and maybe simple for some people. So we're comparing ranges here. And you can see here, and this is roll over volume 2, but you can see just from a quick see that you can see the volume here heavier than the previous bar, and the range is smaller. This is effort versus result. More effort, volume, less result, bar action. This was stopping action to the market. The market conducted rally. In Wyckoff, we wait for a retest of markets. We wait for the retest. If I draw a line across here, you will see now I take current markets because I can show you charts from 1930. it has a gap that's not filled. You want to take markets that are current, so you can benefit from them the most. See the retest here, same exact situation here. You have an increasing volume, and we have a market that basically increases volume, effort versus result. It's a stopping action by the composite operator, the composite man. It leads to markup to the market. This is the current S&P market. As this market then has this markup phase to the market, this market has showed some selling to the market. Selling to the market, we compare the volume to the area. We can see that the reason why this volume increases is because it takes out sell stops. Those of you that trade know your sell stop, it creates volume. We now have gone lower to the market, and now the market essentially has gotten to the point, once this market breaks, this is that left-hand side that I spoke about earlier, that the increasing volume, increases ranges. This is what phase A of Wyckoff is about. This is where your level of knowledge is poor because of the volatility. Closes don't matter. High-end close, low-end close, high-end close, low-end close. This is a market that should not be traded from the standpoint of moving away from this area. That's just an example of effort versus result, which is discussed in the Wyckoff Simplified. The current market, I expect to stay in some type of trading range to the market. Trading range market. So this is very news dependent. Yesterday we went up because of President Trump with the tariff. They went down because of the recessionary. It's very news dependent, very difficult to trade. That's effort versus result. If we talk about selling tails and we talk about the distribution process of the market, now the same as the opposite as well too. Pardon me. We can see the difference in distribution process. This is copper. It's an economic indicator, as you know, for housing. So we take this particular subject, market, and we see selling, selling, selling.
And these are all bars that have closes near the low, and they're wide-ranging bars that are testing the highs.
Correct. So in a bullish market, these are sometimes probes to go higher. The problem with the market right now is as the market goes from this left-hand side to the right-hand side, we mark this because it's a reactionary low before the high. We mark that area. So instead of the demand on the right-hand side of this trading range, the market tells you that it's supply. So I talked about this in the Wyckoff Simplified, the change of behavior and change of trend. It's because of this particular bar. Series I talk about this. So if this was a probe to go higher, and that's what up thrusts are in bullish markets, now with this selling here, high volume, they've just killed demand to the market. The subsequent markdown begins. Talk about this briefly. LPSY, the market would have to go to the trading range here. LPSY, but the market was in the markdown phase already. So that's one section of the market that has selling into the market. If you go back to the S&P market real briefly, the truth is the other side as well to the buying, you see that the market is also trying to get these particular market that tries to go up and sells off. But the thing we have to see is we have that sign of weakness on the right-hand side of the market that has to be determined the action of the market. So now we develop this type of trading range, early part of this phase cycle, where the level of knowledge here, and the sign of weakness, if we were to have one, happen somewhere on the right-hand side of the market. So that is really an important aspect of the market. One of the heart of Wyckoff, the market I'm watching currently, is the trading range of the market, because that's the cause aspect of the market. Now, obviously, we don't have time to discuss how to plot these, but we have a situation. This is the euro currency. This market is, I'm watching very carefully because this market is not reacting to the older world events. But anytime you see a market that has continued to go sideways for markets, it's waiting for some type of move out of the market. Well, lo and behold, look what happened right here. Our friend, Mr. Effort versus Result. You have an increase in volume and a shortening of the downward thrust, SOT is what it's called this. We mark this here as our range bottom here. We mark this here temporarily because this is the reactionary high. We formed some type of trading range. We also developed a trading range in this whole section. Well, as you can see, as this market is navigating here, it's building what we call cost of the market. This is really the heart of Wyckoff because most markets stay within trading ranges of markets. Preparation phase, markup phase, and the markdown phase happens eventually in markets. In Wyckoff Simplified, I show where those areas are where the market happens to be near the creek resistance. Market can mark up, or they'll show weakness in the creek support where the market can hold that spring and rallying. So the three basic principles are always key to what we do. But what's really important is to know where you're at in the phases of Wyckoff. In the A phase, the volatility phase, is the worst one. And we get to the E phase is when the market's about to move away from that. So that is very important. So anytime a market forms a trading range, it catches my interest big time. It's something that is extremely, extremely, extremely important. Most people don't trade sugar, but here's one that has a reactionary low, and we're dealing in an area of an edge. The edge would be an area where the market has support, edge as a market has resistance, and then we formulate these particular things based upon trading ranges. So I think that the aspect of markets today, they're much more unique than they've ever been because we have markets that are levels that are very high levels. And we basically have 24/7 trading. I traded the trading for in the 80s. It was the US and the rest of the world. As the market became more international, Singapore came online. And they were not very good traders. So I would use the overnight highs and lows in the Singapore markets to trade in the US markets, which was very, very, very effective. And then they got more sophisticated and Europe came more online and Asia became more online. So now you have markets that are much higher levels to what happens. Now, what is important is that when you look at markets today, I was down 859 points. When I was in the trading floor in 1987, the Dow was down 500 points. People essentially jumped out of windows, unfortunately. It was such a percentage-wise loss in the market. Today, down 800 points, that's just another day in the Dow. So it's much more, even though the percentage may be less, the amount of money is so much more. So I really feel to understand the tape reading and where to enter trades and where not to enter trades, I think is one of the important aspects of what we do for Wyckoff. And I think is you go forward and maybe look at the series that I've done or come to the website, that you'll be able to simply understand how markets work. I think that every single trader in the world understands Wyckoff. They don't know Wyckoff by name, but they understand price and volume, because price and volume are the only two indicators that are alive, that are real. Everything else you see is made by a vendor who decided that said, you know what? I'm going to take this market as the market moves as, oh, the RSI is going up or the ADX is going up, the 2-day moving average is going up. These were taken from Wyckoff himself, who didn't invent anything. But what Wyckoff did was he understood how market participants acted, the Keens of the world, the Rockefellers, the Livermores, all these people that traded. He watched their market observations and he was a master at reading the tape. And I think that the great traders in the world, they understand price and volume. Believe me, Warren Buffett understands price and volume. Warren Buffett is a value investor. He buys things that are essentially cheaply priced or priced appropriate for him, and he sells things that are overpriced. He may keep it for 3 months. He may keep it forever because he thinks it has more value. And that's extremely, extremely important because he owns Coca-Cola forever because he has value. And he didn't get involved in the tech stocks because he didn't know the value of them. Now he's a big owner of Apple. But at the time, it took him years upon years to understand what the value of those companies were.
Right.
So it's very important from a Wyckoff standpoint to read the tape of the price and volume by the large market participants that make the market.
Well, and he was so good at demonstrating or identifying the footprints of the very large composite operator types, Warren Buffett being among them. And he would demonstrate or show in the chart the footprints of these people as they were entering into a position and absorbing shares or distributing shares. And he could show and tell the story of their activities through the way the charts were behaving.
And that, I think, is to be honest with you, I think is a lost art today. I think that today, I think that understanding market behavior is important. People try to keep things that are very simple, and they say, well, if it's above a 200-day moving average, buy it. Well, that's a mechanical thing that may or may not work. But Wyckoff, the greatest traders in the world are maybe right 30% of the time. But Wyckoff felt that he could be right 50% of the time by not guessing.
And one of the things that I think is so ingenious, and we're running out of time here, but is the idea of context, because like you had pointed out about the left side of the trading range and how it behaves differently, price and volume behave differently than on the right side of the trading range, and the context of understanding one end of the trading range from the other and what has to happen to get there is really the story of the composite operator either coming into and building a position or distributing a position. And so if we can understand that, just the context of how a trading range will unfold is pure genius.
Well, I think, Bruce, what you do so wonderfully in the way you present, and I actually stole the word from you guys, to be honest with you, you talk about market structure. I use different terminology, but the structure of market is very important. We don't see as much classical Wyckoff as maybe we'd like to see sometimes, but we have to have a foundation and a blueprint.
But
and when you present your things, you present things in such an eloquent way, and you talk about structure. And I talk about structure, I'm using your word now, okay? Because it's such a great word, a structure, and Roman's word, of how markets actually operate. I don't use that particular word, I do now, but you understanding the tape, the amount of shares that get thrown upon the market and what the result of those shares are. That's an extreme aspect of Wyckoff to understand that. You have to understand every nuance, no, but you have to understand the left-hand side, the right-hand side, where to place trades, where to stay out of the market. Those are very large trade decisions, and structure of how to take the position or not take it are key markets, because you can be able to reduce risk. There's always a tremendous amount of risk in markets, but we try to reduce it as best we can, and there are areas that we can do that with.
Gary Fullett, it's been such a pleasure. You are such a generous soul in the Wyckoff community with your wonderful content, free lessons, and so on. Please go to Gary's website. And Gary, please come back. We want you to come back often.
As long as I'm vertical and not horizontal, as they say, I'll be happy to come as often as you'll have me.
Well, wonderful. And thank you. And we will see you all next time.